Nobody saw this coming. February 7th, 2025. Silver crashed on good news. Gold tumbled on strong jobs data. Markets cheered. Wall Street applauded. Then the revision data leaked. They overstated employment by 862,000 jobs. The Shanghai premium doubled overnight to $6. 6. That's not a spread. That's a scream. And if you think this sounds like paranoia, good. That reflex, that instant dismissal, that's programming. They profit when you laugh first and verify never. They win when your skepticism only flows downward, toward people like me, never upward toward institutions that have been caught lying under oath in federal court with case numbers you can look up right now. This isn't prediction. This is pattern recognition. And the pattern has repeated 3 times in recorded history. Every single time, it destroys the empire that ignores it. Every single time, it transfers wealth from those who trusted institutions to those who trusted mathematics. Every single time, the warning signs were dismissed as conspiracy until the day the banks didn't open. Rome, Amsterdam, London. Same pattern, same sequence, same outcome. And if you think America is special, if you think this time is different, you're not paying attention to what just leaked. Let me show you the cycle. The cycle of collapse. It has 3 phases, and we are currently in phase 3. Phase 1 is debasement. The empire debases its currency to fund wars it cannot afford and welfare it cannot sustain. Rome did this for 200 years. They started with coins that were 95% silver. By the time the empire collapsed, their coins were 5% silver, spray-painted to look real. The soldiers knew. The merchants knew. The people holding those coins found out last. Verified. You can check the metallurgical analysis of Roman denarii in any museum archive. The data exists. Phase 2 is the debt trap. The empire borrows against future productivity that will never exist. The Dutch did this in the 1700s. They built a trading empire on credit, fought wars on 4 continents with borrowed gold, and when the debt came due, their currency collapsed in 18 months. Merchants who held guilders lost everything. Merchants who held physical gold survived. Verified. Check the Amsterdam financial crisis records of 1772 through 1773. The documentation is public. Phase 3 is loss of reserve status. The world stops accepting your currency as payment. This happened to Britain after World War II. They were the global reserve currency for over a century. They funded 2 world wars on debt. In 1945, they owed more than their entire GDP. By 1949, the pound had lost reserve status. By 1967, it was devalued by 14% overnight. People holding pounds were wiped out. People holding assets outside the banking system were fine. Verified. Read the Bretton Woods transcripts. Britain fought to keep reserve status and lost because the math made it impossible. Now apply this to today. Right now? Not someday. Now. The United States has debased its currency by expanding the money supply 40% since 2020. You can verify this with M2 data from the Federal Reserve's own website. They print, you pay. That's phase 1. The United States carries $36 trillion in federal debt, growing by $1 trillion every 100 days. Interest payments alone now exceed the entire defense budget. That's phase 2. The debt trap is closing. And phase 3 is already here. China and Russia settled oil trades in yuan in 2023. Saudi Arabia is accepting yuan for crude. The BRICS nations are building a commodity-backed settlement system that bypasses the dollar entirely. When the world stops needing dollars to buy oil, to buy food, to settle trade, the dollar becomes just another piece of paper backed by a government that's $36 trillion in debt. We are not approaching the cliff. We have already walked off it. The ground just hasn't appeared yet. Now here's what they're not telling you. The jobs data that came out February 7th showed 130,000 jobs added in January. Markets rallied. Media celebrated. Strong economy, they said. Soft landing, they said. Then the revision data leaked. The Bureau of Labor Statistics, the same agency that releases these headlines every month, quietly admitted they overstated job growth by 862,000 jobs. Not a rounding error. Not a minor adjustment. 862,000 fake jobs that never existed, reported as real for over a year. That brings the total job growth for 2025 down to 181,000 for the entire year. That's 15,000 jobs per month average in an economy that needs 150,000 just to keep up with population growth. This isn't a slowdown. This is economic collapse disguised as a headline and corrected in fine print months later when nobody's watching. And this isn't the first time. 2023 revised lower. 2024 revised lower. 2025 revised even lower. 3 straight years of systematically overstating employment by over 1 million jobs total versus actual payroll records. They lie in the headline. They admit it in the revision. And by the time the truth comes out, you've already made decisions based on fake data. You've already stayed in positions you should have exited. You've already trusted numbers that were designed to deceive. Mathematical certainty. You can verify every revision I just mentioned on the BLS website under benchmark revisions. The data is public. They're just betting you won't look. Now watch what happened the moment that jobs headline hit. Gold dropped. Silver got smashed. Western spot silver fell from $84 to $82 in minutes. Futures hit 83. Standard suppression playbook. Good news, smash the metals. But here's what they didn't expect. The Shanghai premium. Silver in Shanghai was trading at $90 spot, $93 futures. That's a $6 premium over Western prices. Last week it was $3.77. It doubled. When Eastern physical markets are paying $6 more per ounce than Western paper markets, that's not arbitrage. That's a scream. That's physical buyers saying we don't trust your paper pricing anymore. We will pay any premium to get real metal in our hands. You can verify Shanghai Futures Exchange data yourself. It's public. It's timestamped. It's real. Here's what that means. The suppression didn't hold. Gold and silver have now retraced nearly all of the losses from that smash. Gold is confirming a breakout over $5,100 as I'm recording this. Silver reclaimed the 150 exponential moving average on the hourly chart, a level that had been rock-solid support for weeks and then broke during the last sell-off. It's back above it now. That's a structural shift. What was resistance is now support. The technicals are aligning with the fundamentals. And the fundamentals are screaming. February silver deliveries at the COMEX just hit 23 million ounces. That's 45,592 contracts standing for delivery. Here's why that matters. That number is now well over the total open interest that existed in the February contract at the end of January. Over 100% of open interest issued delivery notices. Read that again. More people demanded physical delivery than there were contracts open when the month started. When deliveries exceed the entire open interest at contract start, that's physical demand overwhelming paper positioning. That's not normal. That's stress. You can check COMEX delivery reports yourself. They're dated, verifiable, public, posted every single day. Now look at March. Current open interest, 68,366 contracts. That represents 342 million ounces of paper claims on silver. February 27th is first notice day for March delivery. That's 2 weeks from now. That's when traders must declare whether they want physical silver or cash settlement. If delivery rates stay anywhere near February levels, if even a fraction of those 342 million ounces demand physical, the COMEX faces the biggest physical delivery test in modern history. They've got registered inventory, sure, but nowhere near 342 million ounces. Not even close. When claims exceed available metal and buyers refuse cash settlement, the paper market breaks. Not might break. Will break. Mathematical certainty. And here's the timing most people missed. The Shanghai Metals Exchange closes Sunday, February 15th through Monday, February 23rd for Chinese New Year. 8 days. 8 days where the Eastern physical market that's been setting record premiums goes completely dark. No bids. No buyers. No absorption. Historically, this is when Western banks unleash maximum manipulation. They know the Shanghai bid disappears temporarily. They'll use it to push prices down without Eastern physical buyers absorbing the selling pressure. Every year, same pattern. Chinese New Year closure, metals get smashed, Shanghai reopens, premium reappears. But here's what's different this time. China's silver market is in record backwardation even before the holiday starts. The front-month contract on the Shanghai Futures Exchange has climbed to a record premium over the next active month. That's backwardation. That's when immediate delivery is worth more than future delivery. That only happens when there's a shortage, when inventory is critically low, when buyers are desperate for physical metal right now and can't wait. Investment bar demand and solar panel manufacturing are draining stockpiles faster than supply can replenish. Short sellers on the Shanghai Exchange are paying deferral fees just to avoid taking delivery. They're paying money to not receive the metal they sold. That's not normal market behavior. That's panic. That's shortage. Plain and simple. This is financial warfare. Eastern markets are in backwardation, paying record premiums for physical. Western paper markets are pretending everything is fine, suppressing prices with unlimited paper contracts backed by metal that doesn't exist. But the divergence is widening. When physical and paper prices disconnect by $6 per ounce, and the gap keeps growing, paper loses credibility. Price discovery moves to the physical market. And when that happens, the entities holding paper contracts find out their claims are worth exactly what unbacked paper has always been worth. Nothing. Now connect this to the real economy, because these dots don't get connected in the mainstream. 9 large U.S. companies filed bankruptcy last week. The 3-week rolling average is over 6 bankruptcies per week. Large corporate bankruptcies are at the highest level since COVID. Consumer debt defaults are at the highest level since 2017. The total delinquency rate is 4.8% of all outstanding U.S. household debt. That's Q4 2025. That's the highest in 8 years. Employment overstated by over 1 million jobs. Corporate bankruptcies at COVID levels. Consumer defaults at 8-year highs. Yet the entire commodity complex is breaking out. Silver up 150% in the past year. Gold up 76%. The dollar down 10%. That's not recovery. That's currency debasement meeting supply constraints while the real economy collapses underneath nominal price increases. Look at the equity markets. Insane volatility. S&P 500 down 0.3%. Nasdaq down 0.35%. Russell 2000 down 1.25% after rallying on the jobs headline. Crypto erased nearly $90 billion in market cap in hours. Bitcoin below 66,000. Ethereum touched 1,900. Markets don't whipsaw like this when the underlying data supports the narrative. This is positioning chaos. This is algorithmic trading trying to front-run a collapse it can feel but can't quantify. This is the smart money leaving. And look at the bond market. The bond market doesn't lie. It can't. It's too big to manipulate with sentiment. 10-year Treasury yields barely moved. December 2025 for 0.175%. January for 0.173%. February for 0.177%. Flat. Dead flat. Bond markets are not buying the strong economy story. If employment were truly robust, if growth were real, yields would be rising as the Fed tightens and investors demand higher returns. They're not. Yields are flat because bond traders are pricing what the revised data shows. Economic weakness, recession risk, and an eventual Fed pivot back to accommodation, back to money printing, back to debasement. The bond market is telling you the truth. You just have to listen. Here's the technical signal most people missed. Silver dropped to $82 and briefly fell below the 150 exponential moving average on the hourly chart. That level had acted as solid support for weeks. When it broke lower earlier in this move, price collapsed hard from around $90 all the way down to the 63.90 overnight low. Brutal. But today, after days of chop and consolidation, price reclaimed that level. It's back above the 150 EMA on the hourly. That's a structural shift. What was overhead resistance is now underneath as potential support. Does this mean silver is going to the moon tomorrow? No. Does it mean price rockets higher from here? Absolutely not. Support needs confirmation. Price has to hold above it on retests. Volume needs to back it. Momentum needs to build. But this is another piece of confluence. The technicals are starting to align with the fundamentals. We're seeing the $6 Shanghai premium. Record backwardation. Delivery pressure building into February 27th, first notice day. When multiple factors line up like this, when fundamentals and technicals converge, that's when markets move violently. But let me be clear. This is not a buy signal. This is not advice. I don't tell you what to do with your money. I share raw data, verifiable and public, straight from the exchanges. You use your own brain. You do your own verification. You make your own decisions. The ones who actually do that homework, who pull the COMEX reports, who check the Shanghai data, who verify the BLS revisions, they see the bigger picture. They understand why delivery ratios matter. They know what persistent premiums mean when they won't close. The ones waiting for someone else to spoon-feed them comfortable explanations, they'll stay confused until it's too late. Now here's something else that just surfaced. The CME is considering launching rare earth futures contracts. When exchanges create futures for materials critical to defense, technology, energy infrastructure, that's institutional acknowledgement that strategic supply chains matter. But it's also setting up the same paper manipulation that has plagued precious metals for decades. Physical shortage, paper abundance, price suppression until the divergence breaks and the system fractures. They're extending the playbook to rare earths because the playbook still works on metals. For now, let's talk about the bearish case because it matters. You can't unsee the bullish data once you verify it, but you also can't ignore the tools the system still has. Jobs data was massively revised for the full year, yes, but January still showed 130,000 jobs added. Unemployment is still 4.3%. That's not recession-level weakness in the current month headline. Markets can rally on headline strength for extended periods before the revisions matter to price action. Silver volatility is extreme. Moves in both directions shake out position traders before any actual supply crunch forces a delivery failure. March 1st notice day is still 2 weeks away. Contracts can roll. Positions can close. Cash settlement can be enforced. The system has more tools than most people realize for avoiding delivery failures, even when physical tightness is real. Shanghai closes for Chinese New Year, creating an 8-day manipulation window without Eastern buyers absorbing paper selling. Western banks can push prices lower temporarily. The 150 EMA support could break again. Technicals could deteriorate. Price could retest lower levels before delivery pressure materializes. Corporate bankruptcies are elevated at 6 per week, but we're not at 2008 crisis levels yet. Consumer defaults at 4.8% are an 8-year high, but not catastrophic. The economy could muddle through stagflation for years without triggering an acute crisis that forces an immediate monetary response. Paper manipulation has persisted for decades despite recurring physical tightness. The system is resilient. It's designed to absorb shocks. It has circuit breakers and settlement mechanisms and legal frameworks that protect the institutions at the expense of the individual. Every bearish delay, every tool they still have, assumes one thing: that paper maintains price discovery control. But that assumption is fracturing. The Shanghai premium is $6. That's not minor arbitrage. That's Eastern markets paying massive premiums for physical delivery while Western institutions manipulate paper lower. When physical and paper diverge to that degree, paper pricing loses credibility. February deliveries already exceeded 100% of open interest. March sits at 342 million ounces of claims, with first notice day approaching February 27th. If delivery intentions follow anywhere near February patterns, the COMEX faces the largest physical test in modern history. The system can suppress paper. It cannot print physical metal when buyers demand delivery instead of accepting cash settlement. Not opinion. Physics. Here's what matters now. February 27th. First notice day for March COMEX silver. 342 million ounces of open interest against limited registered inventory. Shanghai premium at $6, signaling physical disconnection from paper pricing. Chinese New Year closure February 15th through 23rd, creating an 8-day manipulation window. Employment revised down by over 1 million jobs. Systematic overstatement 3 years running. Corporate bankruptcies at COVID highs. Consumer defaults at 8-year highs. Commodities breaking out despite economic deterioration. Technical structure shifted with the 150 EMA reclaimed as potential support. Fundamental structure coiled with delivery pressure building. Geopolitical structure shows East accumulating physical at premium while West manipulates paper lower. Now watch what happens during the Chinese New Year closure. Watch delivery intentions leading up to February 27th. Watch whether the 150 EMA support holds or breaks on the next retest. Watch the Shanghai premium when markets reopen after the holiday. Does it shrink back to normal, or does it widen further to $8, $10, $15? When premiums don't close, when they expand, that's the market screaming that paper has lost control. Verify the employment revision data. Bureau of Labor Statistics benchmark reports. It's all public. Check COMEX delivery statistics. Updated daily. Public. Look up Shanghai backwardation data on the Shanghai Futures Exchange. Verify bankruptcy filings. Check consumer debt statistics from the Federal Reserve. Don't trust the jobs headline. Don't trust my analysis. Trust primary source data you verify independently. The ones who do that homework see what's building. They understand the pattern. They recognize the sequence. They know the outcome. The ones waiting for comfortable mainstream explanations, they're not my concern. I'm not here to convince anyone or predict what you should do with your capital. This is the cycle of collapse. Phase 1, debasement. Phase 2, the debt trap. Phase 3, loss of reserve status. Rome, Amsterdam, London. Same pattern, same sequence, same outcome. And every single time, the wealth transfer was violent and absolute. Those who held paper promises were wiped out. Those who held physical assets, land, gold, silver, commodities, survived and thrived. Not because they were geniuses, because they recognized the pattern and acted before the majority even understood the danger. This is not might happen. This will happen. The only question is timing. The only variable is how much time you have to prepare before the window closes. The warning isn't a buy signal. The warning is verify or stay blind. Your choice. The data is public. The pattern is clear. The outcome is mathematical. You can't unsee it once you verify. Subscribe if you want to see the next chapter of this unfold. Because this story is just beginning. And when it ends, the world will look very, very different.